couple of major concerns that issuers have are filing timely and making sure that they're avoiding SEC comment letters. A lot of times we get asked questions are, what is the staff looking at? What do we need to be worried about? So we're going to talk about a couple of items that lately have garnered a lot of attention and some comments. First, management's discussion and analysis. All right, and so to really understand what the SEC is trying to do with MD&A, you really need to understand the intent. And the intent of MD&A is for the readers to have a view of management's color and insight that they add from that unique perspective that they have. With that in mind, what they're looking for is like results of operations. We want to explain the changes from period to period and why those changes occurred. So that why is very, very important. Liquidity and capital resources. Is it clear that the company can meet its capital needs, can meet its cash flow needs? And have there been any changes in cash flow? Have there been any changes in the sources and the outflows of capital? Trends and uncertainties. Basically you're just disclosing here, is there anything that's an early warning sign, but anything like commitments, demands, trends, things of that sort. And lastly, significant accounting estimates. This is also in your financial statements, but this is more intended to say this is the driving factors of how we came up with that estimate and why it's so difficult to come up with versus just the disclosure you see in your financial statements. The second big item, revenue recognition. Basically they want to know how you're earning revenue, when you recognize it, and why. A lot of key boilerplate language that they get there, but they need it tailored specifically to your company. And lastly, that we'll talk about today is income taxes. Now there's 2 points on income taxes that have seen a lot of focus. First has to do with the rate reconciliation in the disclosures. Basically, you need to be clear on those. Make sure they're all complete and make sure that you're not aggregating items together that really shouldn't be. Mainly want to stick to the 5% rule. Remember the 5% rule, and that's that you take pre-tax income times the federal statutory rate, and anything that is 5% or greater, that number has to have a separate disclosure. Second major component of income taxes is the valuation allowance. All right, and the main thing to remember there is that a lot of estimates involved whether you're establishing that allowance or taking it off. When you're establishing, keep in mind that positive and negative, objective and verifiable evidence need to be taken into account. And when you're pulling that off, you have to ask yourself, is our profitability, is it sustainable? Can our company forecast? What is this long term? Is it, what are the factors that are going into that, and is it sustainable? Overall, keep in mind that the assumptions that you put into these estimates need to be consistent with other assumptions in your financial statements, like for goodwill or other assumptions that are going concern that you might be making as well. Why is all this important? You and your accountants need to be on the same page. You need to get a plan for addressing these items and get it done early. That way you can avoid untimely filings and avoid SEC comment letters.